You found the perfect trade setup. You enter the market, but the price spikes against you by just 15 pips, and suddenly, your entire trading account is wiped out. What happened? You used the wrong lot size. In Forex, your strategy does not determine your survival. Your position sizing does. Today, I will show you exactly what a Forex lot size calculator is and how to use it mathematically to bulletproof your capital and ensure you never blow another account. The biggest misconception in retail trading is that a pip is worth a fixed amount of money. Beginners assume that if they risk 20 pips on the euro dollar, it will cost them exactly the same amount of money as risking 20 pips on the British pound Japanese yen. This is mathematically false. The Forex market operates in currency pairs, meaning the value of a pip fluctuates depending on the quote currency, the second currency in the pair. If your account is denominated in US dollars, a standard lot on euro dollar equates to exactly $10 per pip. But if you trade a pair like US dollar Swiss franc, or a volatile cross pair like pound yen, that pip value shifts dynamically based on current exchange rates. If you blindly apply a fixed lot size across all these different assets without adjusting for the quote currency conversion, you are essentially gambling. You might think you are risking 1% of your account, but because of the pip value discrepancy, you could actually be risking 2 or 3%. Over a series of trades, this hidden mathematical error will destroy your risk-to-reward ratio and bleed your account dry. Before we calculate risk, we must define volume. In Forex, you do not buy individual units of currency. You buy batches. These batches are called lots. There are three primary categories of lots you need to understand. First is the standard lot, represented as 1.0 on your trading platform. A standard lot controls 100,000 units of the base currency. For pairs where the US dollar is the quote currency, this typically equates to $10 per pip of movement. Second is the mini lot, represented as 0.10. This controls 10,000 units of currency. It operates at exactly 1/10 the scale of a standard lot, meaning each pip is worth approximately $1. Third is the micro lot, represented as 0.01. This controls 1,000 units of currency, valuing each pip at roughly 10 cents. This is the ultimate tool for precise risk management on smaller accounts. The lot size is the ultimate multiplier. It takes the distance of your stop loss and multiplies it into real financial risk. If your lot size is too large, a tiny market fluctuation will trigger a massive financial loss. If your lot size is too small, a massive winning trend will yield practically zero return. Finding the perfect mathematical balance between your stop-loss distance and your lot size is the foundation of professional trading. To find that perfect balance, you must use a specific formula. You take your total account balance, multiply it by the percentage you want to risk, and then divide that number by your stop-loss in pips multiplied by the dynamic pip value of that specific currency pair. Doing this math manually in your head while trading live is a recipe for disaster. The Forex market moves at lightning speed. When a Tier 1 news event hits, or a sudden change of character prints on the 15-minute chart, you only have seconds to execute your entry. If you pause to manually calculate exchange rates, convert quote currencies, and divide decimal points, the setup will be gone before you even touch your keyboard. Or worse, in your rush, you misplace a decimal point and accidentally execute a 10-lot trade instead of a 1-lot trade, facing instant liquidation. This is exactly why institutional algorithms and professional traders never calculate position sizing manually. They automate the math. And the tool we use to automate this critical step is the Forex Lot Size Calculator. A Forex Lot Size Calculator is a digital tool that instantly computes the exact lot volume you need to execute based on your personal risk parameters and the real-time exchange rates of the market. It removes all human error, all emotion, and all guesswork. Let me walk you through exactly how to use it, step by step. Step 1. Input your instrument. You select the exact currency pair, index, or metal you are trading. The calculator uses this to pull the live exchange rate, instantly solving the pip value discrepancy we discussed earlier. Step 2. Account currency. Select the baseline currency of your actual trading account, whether that is USD, EUR, or GBP. This ensures all conversions map correctly to your balance. Step 3. Account size. Enter your current exact account equity. Do not use your starting balance from a month ago. Risk must dynamically scale based on exactly what you possess at this very second. Step 4. Risk percentage. This is the most crucial metric. Professional traders strictly risk between 0.5 and 2% per trade. If your account size is $10,000 and you input 1% risk, the calculator locks your maximum potential loss at exactly $100. Step 5. Stop loss in pips. This is the distance from your entry price to your structural invalidation level. Once you input these 5 variables, the calculator instantly outputs the exact lot size. For example, 0.43 lots. You copy that exact number into your trading platform and execute the trade. If your stop loss is hit, you will lose exactly 1% of your account, not 1.2%, not 3%, exactly 1%. Complete mathematical control. If you refuse to use a calculator, you will inevitably fall into the fixed lot trap. This is the primary reason beginners cannot pass prop firm challenges. Let us say you trade a fixed 1.0 standard lot on every single setup. On trade A, the market structure requires a tight 10-pip stop loss. A loss here costs you $100. On trade B, market volatility is high, requiring a wider 30-pip stop loss to stay safe from noise. Because you blindly use the same 1.0 fixed lot, a loss on trade B costs you $300. Your losses are highly erratic. One bad trade wipes out the profits from 3 good trades. You are structurally capping your ability to grow. By using a lot size calculator, your risk becomes static, but your lot size becomes dynamic. If you need a 30-pip stop loss, the calculator automatically shrinks your lot size to ensure you only lose 1%. If you have a sniper entry with a tiny 5-pip stop loss, the calculator aggressively increases your lot size, allowing you to heavily capitalize on the tight risk while still mathematically guaranteeing you only lose 1% if stopped out. You adapt to the market structure, rather than forcing the market to respect your fixed lot size. The lot size calculator becomes absolutely mandatory when you transition from basic Forex pairs to assets like gold, US 30, or the NASDAQ. Unlike standard currency pairs, indices and metals have radically different contract sizes and tick values depending on your specific broker. A 1.0 lot on US 30 with broker A might equal $1 per point, while a 1.0 lot on broker B equals $10 per point. If you guess your lot size on volatile indices without a calculator, you can literally blow your account in a single 1-minute candle. Always use an instrument-specific calculator and ideally, test the output on a demo account first to verify your broker's exact contract specifications. Let us summarize. A Forex lot size calculator is not an optional accessory. It is a mandatory survival tool. The market is chaotic, volatile, and deeply unforgiving. The only variable you have absolute control over is your risk. By calculating your lot size precisely before every single execution, you neutralize the threat of fluctuating pip values, you eliminate emotional scaling, and you build an unbreakable mathematical wall around your capital. Professional trading is simply managing risk while letting the probabilities play out. Use the calculator, protect your equity, and trade with absolute mathematical confidence. If this guide helped you, subscribe to the channel, and I will see you in the next masterclass.